There's an FOMC meeting this week, and it looks like the Fed is going to pause, causing many people to believe that soft landing is imminent and we're going to just randomly re-enter a raging bull market. But there's a lot of other things to look at besides just a potential pause, which of course is not a pivot. We're going to dig into everything macro. It's Macro Monday on a Tuesday. Today I've got James Lavish and Dave Weisberger joining. As one of you said in the comments, Mike McGlone is Mike McGone this week, but we will have him back next week, guys. Let's go.
Let's go.
What is up, everybody? I'm Scott Melker, also known as the Wolf of All Streets. Before we get started, please subscribe to the channel and hit that like button. It's been a long week away. I went around the world and back, and I have to tell you that it's a very good thing I did, because I was super depressed about crypto in the United States, and then I went to Asia, where there is a never-ending bull market. Nobody cares about the United States. Nobody cares about our regulators. Conferences are absolutely massive, and it's like crypto Coachella over there, crypto palooza, if you will. Literally, Token 2049, a conference that I just attended in Singapore. You might remember last year I went from Mainnet in New York City, which was one of the more depressing conferences I've ever been to, a year ago, because all anyone wanted to talk about was regulation and crackdowns. And I understand, because it's brutal in the United States. And then I went over there, and it was this insane conference, exciting, over 3,000 people. Well, this year I went again, and it was over 10,000 people. Went from one floor to 3 floors, had 1,000 exhibitors there, 1,000. And unlike the last conference I went to in the United States, those exhibitors were not just lawyers and accountants. At Consensus this year when I went, it was literally half lawyers and accountants at the booths. Absolutely depressing, but important to know, guys. This industry is alive and well on the other side of the world, and sadly, those of us in the United States are currently just missing out. Now that I've gone on that rampage, I'm going to go ahead and bring on James and Dave. No McGlone today, but we'll have him next week. Guys, I'm glad we're able to do this on a Taco Tuesday again, James, I think, as you put it in a tweet. I want to show you guys this amazing statement just to get us kicked off. A tweet that I just saw this morning. Well, here, let me give it to you. Yellen says soft landing scenario can withstand risks from auto strike, government shutdown threat, student loan repayment resumption. And as I said here, Yellen says nothing will change her narrative no matter what, because she will get fired. James, you and I were just talking about this before. I'll let you go first. She literally says there's nothing in the world that can stop the soft landing. It's just happening no matter what.
Because it's the narrative, man. You gotta stick with the narrative. And they'll say soft landing all the way until we drive this economy into the ground. We spike unemployment. You know, we're right now we're staring down stagflation. She didn't even talk about oil prices approaching $100. You know, Europe just raised rates in the face of economic slowdown. Like, the central bankers, they have to keep the narrative, and they will drive the economy into the ground, because they have to, in order to keep inflation in check and keep confidence in their currencies. Period. And she needs to, keep that narrative, because if you noticed or didn't notice, the Treasury borrowed another $1 trillion this year, or this last month, basically.
33 trillion. We crossed it. Good job.
So if you look at the end of June, or the end of June, I believe it was 32.3 trillion. So we've borrowed $1 trillion since June. So they have to keep the narrative, period, because they have to keep borrowing, period. So they have to keep the confidence in the currency in order to issue this debt that people are going to allow the Treasury to borrow dollars and pay them back with cheaper dollars. It's kind of a sad state of affairs.
And right before we go to Dave, you were sort of telling me before that they always get the soft landing narrative wrong.
Always.
You were reading from something from Anna Wong, who we had on the show. And that's
Yeah.
McClone's favorite person. Every morning he says, I was on a call with our head economist on a walk. Right. And so, but why do we always get this soft landing narrative wrong? You know, the TLDR for the normie people like us who may not quite understand.
So what Anna was saying was, and she wrote a piece in Bloomberg, I think it was yesterday. And what she was saying is that we always get the soft landing wrong because of the probability of distributions. Dave will understand this. You know, when you have between 68 and 95% confidence, and you see where those probability of distributions are for unemployment in particular. Unemployment always spikes right at the beginning of the of a downturn, economic downturn, or recession. And I've talked about this for a while, but basically what she's saying is that the problem is that economists always get it wrong because they're looking at the probability distribution and they're discounting. They're every single time they ignore that fat tail of that unemployment spike of over 7%. And there's a big hump in there that shows that distribution, right? So on the number of recessions. So we got it wrong in 91. They got it wrong in 2001. They got it wrong in 2008. They got it wrong in 2020. Soft landing, soft landing, soft landing, soft landing. And it was not soft. It was not soft. It was not soft. It was not soft. So, and here we are again. We're right. And to me,
it's worse this time.
Yeah. I mean, Dave, you tell me, but I was just talking to my partner on the Bitcoin Opportunity Fund yesterday, and David, and I was just staring at the markets and looking at the numbers and thinking it's just too complacent. Just looking at the VIX, looking at the PEs, it just seems just way too complacent. Everybody is just kind of like, oh, I think it looks like we're gonna, the Fed's gonna thread this needle and we're gonna have the soft landing and Goldilocks is alive and well. I mean, you tell me, what do you think?
Yeah, I don't believe in fairy tales as a general rule. I think that I have a couple of responses. I mean, the Yellen thing, I will repeat a quote from the father of propaganda: "A lie told once remains a lie, but a lie told 1,000 times becomes the truth." I think that there's a lot of that going on with regard to narratives in this administration, and frankly, a lot of them. But what's interesting is, and I've said this many times, I mean, Jerome Powell is many things, but dumb is not one of them. Mm-hmm. And he absolutely understands the importance of inflationary expectations in the narrative and in controlling inflation. He does understand it. He has talked about it. You have to parse his words more carefully, but I understand. Now, coming from someone who learned economics in the beginning of the 80s, right when Volcker was doing what he was doing and arguing, and I think on the show I've recounted a famous argument I had with Professor Robert Gordon, who at the time wrote the most popular intermediate macro book, gave me a B+ on an essay where I talked about inflationary expectation theory and how
B+ or D+?
Well, B+, but it wasn't an A+, which is what it should have been, because I argued in my paper that inflation, that proper monetary policy could break the back of inflationary expectations, and his book argued it would take 7 years of recession to end the double-digit inflation that we had suffered. And I talked about how I managed to talk to him at graduation in front of my mentor, but let's just say that I gloated a little bit and we'll leave it at that. Powell's talked about inflationary expectations, but we have something going on that's incredibly unprecedented. And if he isn't grinding his teeth down to the gums and isn't incredibly pissed off at the fact that all of the people, Senate, House, and executive branch of the Democratic Party are cheerleading the UAW and saying they have a right to demand massive double-digit percentage pay.
40%. They want 40% pay raise.
And that, when he's trying to dampen inflationary expectations, I feel badly for the man because he is operating alone. They are literally saying, you got inflation, Jerome. We're going to do all the cheerleading in the economy. We're going to be profligate on the fiscal side till the cows come home. We're going to cheerlead people demanding more wages and put pressure on companies. And never forget how much pressure the government can put on companies. So it is a very interesting situation. I'm sure that, you know, at a certain point, he's going to have to throw in the towel. And, you know, and either that, or he's going to engineer what is going to be not a soft landing. I mean, I'm not sure which way it will go. Another fact that's fascinating, if you look at the drawdown of the SPR reserve and chart it against the oil price, what you see is twice now. This is the second time we've had a 3-month period where they actually bought back some teeny little bit. I mean, the numbers are, I mean, I have the chart up here. In July, in June, it was at 353,000, you know, billion, whatever the number is, just 353. In July, they drew down some to 346. Since then, it crept up to 347 and 350. And if you think that there's no relationship between a slight buyback of the Strategic Petroleum Reserve, but most importantly, not, you know, releasing it into the economy and the oil price ticking up, then you're blind, because you can look at the correlation of that chart, Scott. It's unfortunate.
You can always share your charts. I got to teach you that move, but right down below, you just hit present.
Okay.
I
got to put it in
the stream too.
Yeah, let's do this, because
let's do it.
I don't have a chart.
Let's do this.
But
let's do it.
Share screen window.
We're ready for it. I mean, while we're doing that, you can see oil's rally gathers momentum as Brent pops above $95 a barrel.
So you look at the chart and you go back. I don't have this in chart form and the ability to put this, but if you read down here, you'll see it started the year at 371. And you know, and you see what's going on, and see that it, you know, when oil prices were coming down, it was.
No, we can't see that, Dave. It's so small.
Yeah,
it's so small.
Anyway, the bottom line is
we got to get Dave. You're screen sized. Yeah.
Yeah. Sorry about that.
Command or hit Command plus.
Yeah, I know how to update. I know how to do that.
Blow it up. Blow it up. Oh, here we go. Look at it. Someone said this was our beautiful boomer moment.
Yeah. I know how. I was just being lazy. Sorry, there's lazy. I am a boomer, but whatever. But you see what's happening. You know, they're withdrawing to cut the price, withdrawing to cut the price. They don't, and it stabilizes. They withdraw to cut the price. They don't, and it starts going up again. I mean, they're kind of caught. And you can see what's happening. They know what they really need to do is draw down the stocks during the election.
Yes.
And so they didn't want to, but now we're sitting with oil at 95, which will feed through the system. And you know, they can do inflation, X food and energy as much as they want. It doesn't, excuse my language, but it doesn't fucking matter, because oil feeds through to other inflation, to pretty much everything that gets produced or transported. And so you can't do inflation X energy. You can only do inflation X measuring the explicit part of energy, but energy will always be part of inflation. So, you know, we're in the Fed is in a difficult situation. There's no version of reality
possible
where you can, with monetary policy, control consumer inflation in a world where monetary policy for decades has explicitly tried to create asset inflation, capital substitution for labor to suppress consumer inflation. And then everything that the administration is doing on the fiscal side and policy side and regulatory side is increasing consumer inflation specifically by intent. And you just can't, that is not something, a battle that the Federal Reserve can win without causing enormous damage to the economy.
That's right.
I mean, we're going into an election year, there's a snowball's chance in hell that they're going to be willing to cause enormous damage to the economy. I mean, had we been in this situation 6 months ago, maybe, but we're, you know, the nomination deadline is 2 months away. I mean, we don't know what Biden's going to do. I mean, there's a lot of speculation about it, but, you know, unless he has a health problem, there's no way for Democrats to enter the primaries after November, as I understand the DNC rules. Now, I am sure they're going to adjust the DNC rules if they decide not to run him, but the election is starting in earnest in 2 or 3 months. And it's pretty clear that there are some policies, and the UAW, it's not just the UAW, by the way, there's a lot of other unions out there. Wage push inflation is the nightmare scenario for Powell. Repeat this again. It is the nightmare scenario for Powell. And he can't do a damn thing about it.
Coupled with $100 oil. That's
right.
There's nothing you can do. There's
wait.
nothing you can do.
Then James, let me ask you. So we're in this situation now where oil is going up again. McGlone would tell us it's just a sort of a lower high and it's going to crash, of course. But oil is going up again. All the things you guys just described. But now we're expecting a pause at FOMC for September. Right. So does this indicate that Powell is smart and is waiting to see what happened from previous rate hikes? Right. We all know it's lagging. Or are they so lost now that they literally break something in either direction?
All he can do is talk about it.
Yeah. I don't think he's he's lost. They have very few tools they can use, right? So he can stop QT and take his the foot off the pedal there. They can pause rates, which are doing, and see what kind of lagging effects. All the 5 percentage points of rate hikes, it doesn't sound like a lot, but when you come from 0 to 5.5, it's a lot.
11 hikes.
Yeah. So you're starting to see bankruptcies rise, at the same time that you've got the unions demanding higher wages. So you're throwing fuel on the fire there with wages having to go up, which means decreasing margins, which means that you have less money left over to cover your interest payments. And so for these companies who are on the rails, or just a little bit, they're against the rails. If they're just a little bit flying a little bit too close to the sun, it could push them over the edge. And then that's when you see the spike in bankruptcies. And that's what you're kind of watching for. And so he's watching for bankruptcies rising, unemployment spiking, but it's all rear view mirror stuff. That's damage that's already been done from that's lagging effects of the rate raises, right? So there is no good answer for him. If he raises rates into this, he raises them again. There's that only adds to the probability of a major credit event, and so he can't do that. So he pauses while oil is going up. As Dave said, oil and gas they're integral to every single thing that we buy, regardless of what Just Stop Oil wants to say. Every single piece of clothing they have, how they got to the protest, what they ate before the protest, what they're going to eat after the protest, that doesn't matter. Every single thing has oil and energy as a part of that cost and creates that. So there's nothing you can do. He's in pretty much an impossible situation.
Yeah, which I think means just the simplest thing is just to pause for a long while here and see what happens. I mean, and that does make sense.
It's clear that we're above that neutral rate, meaning we are decreasing demand. He's decreasing demand with the rates at where they are because of the cost of capital. Okay, so and that's clear. So he's going to see how long he can hold it there. I mean, there's no reason for him to just spike them again. We're already above the neutral rate. Let's see where it goes.
Right.
I mean, Dave, just real quick, I know you're about to jump in, but I mean, you add into this rising oil prices the fact that if you look, savings are at historic lows and almost gone. Everything that consumers saving had from, the COVID bonus there, the bonus check that everybody got, and that credit card debt is at all-time highs.
Right.
So the consumers are struggling, and it's not like you can take a loan. So consumers are struggling hard right now, and you add in higher gas prices, that only makes everything worse, to your point.
So here's the point, and there's an interesting feedback. If he raises rates, the reason raising rates is used to calm inflation is by killing aggregate demand. That's the idea, right? The idea is you hurt aggregate demand, and potentially hurting aggregate demand is a very clinical term. What he's basically talking about is forcing people to have no ability to buy or spend, which generally involves some form of credit event. What does the Fed want to avoid? Large-scale credit contagion. So they need to push but not push. But the other big problem here, and it's a huge one, and I'm sharing the screen. I don't know if people can see it, but the economic data that shows consumer loans. This is recent, but if you do 5 years, you could see this is the pandemic, and now you see where we are. And if you go back to max, you can see we're all-time highs, Now, this is consumer loan.
That's credit card debt. So let's be clear. That's credit card debt that back in 2020, the rates on this were down around 9 to 11%. And now they're up over 25 to 28%.
Right. So that's my point. As he raises rates, what he's actually doing is causing wage push inflation, because he's causing people to need more money and therefore demand more to live. So in a way, raising rates has an inflationary impact to it as well, in a world where the cost of living is directly impacted by those rates. And yes, it on the corporate side, it means they have less to spend and they have less to push. Yes, we understand it. But on consumer demand side, it is interesting, because if you look at the average, what are people going to vote on? People are going to vote based on, are they better off or worse off? Well, at the end of the day, if your revolving credit line, if your home equity loan resets, if all these things are taking money from you as he raises rates, that causes people to demand more and get more strident about it. And so that is a big problem with all the union things that are going on, because you can't really blame the labor unions, can't blame the workers. Their costs have gone through the roof, right? We can manipulate the CPI as much as you want, but if you can't import it, and if you can't import it, and if it's not in a technologically, if it's not something that just the tech is getting better, and so prices are coming down, everything that's service oriented or made in America, frankly, the prices are up dramatically higher than the stated inflation rate. And things like you're educating your kids, or your medical care, or your rent, these are things that are up higher. And then when you add to that the fact that how many people use their houses as an ATM, and those revolving credit lines that are from houses, most of them reset with as interest rates. They're all indexed to the prime rate. And so you have a huge impact here. That impact is something that I'm sure he's being talked about, right? Because it is a double-edged sword, and that's kind of something that people don't generally think about.
Yeah, go ahead, James.
Well, I was going to let me see if I can share my screen here.
Here we go, guys. I'm ready for it. But I see. This is. By the way, this is my tactic for getting a free Bloomberg terminal, is to get you, James, and Mike to just share your screen constantly, so I don't have to pay like $25,000 a month or whatever it costs these days.
The problem is I'm on Chrome, and and I'm not.
Oh, and you need the permissions.
So, yeah.
Next time we'll try it before.
We'll try it before. But let me see here. Let me see if I can get it on Chrome.
I know you can do it, because I'm doing it, which means it can be done.
Yep.
And Dave's probably doing it. But while we're discussing that, and we'll go right back to that as you're trying, James, but we have to obviously mention the other part of the topic, which comes from our good friend Yusko. Bitcoin's on sale, he says, but customers are running out of the store, which is a classic. Obviously, he's pointing to the halving and the tidal wave of cash that's going to come in when we get an ETF approval. McGlone's not here to tell us that Bitcoin's going to $9,000. So this is our chance, guys. This is our chance to say bullish things about Bitcoin.
Well, look, you know my opinion. Mike and I now have a Twitter-oriented steak dinner bet on 40 versus 10. I would have tightened the range too. I mean, I feel pretty good about that. I've wanted to go to Peter Luger's for a while, so
My favorite place on earth. Thank you.
I'm
coming. I'm coming, and I'm buying you both dinner.
That's
James,
fine.
fly
But
in.
the point that's really interesting about what's going on with Bitcoin is, and I made this point this morning. I tweeted it out because somebody was talking about, they were just going on and on about macro and this, that, and the other thing. And I basically was saying, listen, Bitcoin trades like an option on its own adoption. The reason the 4-year cycles matter, and the reason the halving cycles matter, there's less supply, and sure, you can do a supply side only model. I think it's kind of bullshit, but whatever. But what it does show is every single halving we get through, where the mining industry and the network strength is confirmed, and things continue to go up and to the right, it more and more justifies the vision of Bitcoin as a global store of value, and it puts more and more distance between Bitcoin and other technologies trying to ever create what Bitcoin has created in terms of a global network. And technologists, and it's fascinating for something that was built by technologists. It's fascinating how technologists are ignorant sometimes of how network effects go. I mean, there have been many examples throughout history where the superior technology doesn't win, many, because people already adopted it and the marginal difference in the new technology was not sufficient. It takes truly disruptive technology to displace old technologies. And, everyone uses Betamax and VHS, but there are so many, it's not even funny. The reality is Bitcoin technology, there's been some adaptations with ordinals, and that's actually a very good thing in many respects. I mean, I completely can't comprehend the Bitcoin maxis who don't like that and don't see usage of the blockchain as useful. But what's important is up and to the right, block by block, bit by bit, what's going on in the network. And every time there's a halving and every time the monetary policy of Bitcoin is proven to be reasonable and is proven to work, it creates even more momentum towards its global adoption. And right now the market's pricing the chance of Bitcoin becoming the digital store of value globally at well less than 5%, right? And it was well less than 5%. It was in a similar place, not all that long ago. And the network is dramatically stronger now. There's much more adoption. We even have the accounting rules taking the for businesses out of the way. I mean, honestly, and the other thing that I pointed out a couple of weeks ago is even the IMF is saying don't try to ban crypto because they know it'll drive it underground and make it stronger. The reality is now they want to try to co-opt it.
Now, they want to control it. I don't see that as good news, but it's definitely a capitulation on the fact that it's not going anywhere.
But what does co-opting look like? Co-opting looks like, okay, it's going to go up a lot. We just want to control it. How do you control it? There's only one way to control it is to buy it. So what are they going to try to do? Shake people out of it? Yeah, I mean, I'm not really a conspiracy theorist on that score. I don't think that it actually works that way, but it ultimately becomes that. So the only thing that's really holding the market down right now, and I've said this before and I'll say it again, it's fear of Binance being a slightly larger FTX event. That is literally the only story. That is the overhang to the entire crypto market and Bitcoin in particular. And I frankly think it's bullshit. I mean, not necessarily because Binance isn't going to get punished, but I just don't see. And I'd love to hear Mike Alfred explain.
I think that, let me say this. I think it is becoming more bullshit with time because the longer it takes for something to happen, if it's going to happen, the less market share Binance has, the more priced in the assumption that it will happen is there, and the less impactful that news will be, right? I mean, there's a lot going on with Binance, right? Binance, first of all, SEC ripped into Binance US over shaky asset custody. But by the way, if you guys saw, then, it's the wrong tweet. I'll have to get it. But then Binance US, the SEC lost again. A judge rejected the SEC yesterday in trying to get into Binance US technology and books. But crypto hiring woes for Binance. Binance US continues. The CEO, Brian Schroeder, it's like the 15th CEO, but he left, and people are leaving at every level. But that's my point. If this ship is sinking, everyone's already getting off. It's not going to matter by the time. And I think I saw a number as high as that they've gone from 80% down to 30% market share. So I think there's no way this will be bigger than FTX because FTX happened overnight.
Right. That's one point. And the other point is FTX had an $8 billion hole in their balance sheet. There was a ton of forced selling. They bankrupted a ton of professional investors who then had to sell their remaining assets. Forced sales is what causes things to go down. People not being able to speculate might hurt a lot of altcoins where liquidity bequeaths liquidity and there's a lot of garbage. But with Bitcoin, that's not really relevant. The only thing that's relevant to Bitcoin in the Binance case is, do investors have Bitcoin on Binance that's not really there? And from all accounts, I have not seen any proof that that is the case. So if there's no forced selling, then there will be disruption to the market because professional investors are using Binance futures. Binance, the spot exchange, I think is less and less of an issue.
Yeah.
The sole issue is Binance futures.
But you just hit it on the head, Dave. That's the problem. The uncertainty. Period. The uncertainty is you cannot see what the liabilities are. Yeah, you can verify the assets, but there's no way to verify the liabilities. If you can't verify the liabilities and what they have used, like how much Bitcoin they have possibly used as collateral against them they may own that may come due, that they will have to liquidate Bitcoin in order to, you know, meet those obligations. That's what you can't see. And so when you have uncertainty, you have markets that just trend either sideways or lower, period.
Right.
That's the way it is.
And that is exactly my point. But my point is that unlike FTX, where the known unknown,
my point.
we knew, we didn't know. It happened overnight, and immediately when the market realized that they had replaced all the Bitcoin and Ethereum that they were holding from customer collateral with sand coins, which was bullshit, it's a problem. Now, the allegation, which I've not seen proof of, and I think is extremely important to understand whether it's true or not true, is that they've replaced, that Binance has replaced it with BNB. I mean, they're explicitly denying that. And to me, that's the central question. I don't know the answer to it, but provided that the Bitcoin and Ether that are posted and stable coins that are posted as collateral on Binance Future are still there, then even if the you know, it gets shut down overnight, it would cause disruption. But
Right.
that could be a mass buying opportunity in Bitcoin and Ether. It could be, well, not necessarily Ether, because if all coins all get quiesced for a 6-month period as people sort out what the next market will be, you know, Ether, obviously it's one of their big use cases, but Bitcoin for sure, there's no impact. I mean, keep in mind, the biggest rally off the close, the biggest rally we have seen, like, you know, in recent times, was literally when BitMEX died. BitMEX had 80% market share of Bitcoin derivatives, 80%, and went to, you know, down to less than 10% almost overnight after they kicked the, you know, after they pulled the plug during the March rally and the March failure. Nobody
Right.
cared. It didn't matter, because anything you want to say about Arthur,
And everyone loves Arthur. I had lunch with him in Singapore like 3 days ago. He's the most popular person at that conference.
he's freaking brilliant. I mean, I was one of the first people when he went to Substack to subscribe, because he's brilliant. I love reading his stuff. I mean, I learn every single time I read his stuff. I'd love to meet him. But you know, one of these days, if we're in the same place, you can introduce me. But in any case, Arthur,
it was a group lunch, and I'm not friendly, but we did sit right together, and he threw a hilarious party that people were crawling through the woods to sneak into, and ran out of liquor in 45 minutes. Anyways, go ahead.
but the point is that BitMEX didn't lose customer collateral, and so therefore there was no forced selling, and therefore the rally, despite its demise, was incredibly sharp. If there was a Binance disaster, and I'm not saying it's going to happen, I have no knowledge of it. I'm not wishing ill on anybody. But if it happens and there's no forced selling from collateral, the rally, the God candle that will result at the end of that will be epic. And that's even without the ETF being approved. If you add that to the ETF being approved, and it could be ridiculous. And all the people who are patiently buying will lose their patience. I'm not talking about a, you know, $3,000 or $5,000 rally where it's only speculators and there's no spot buying, which collapses immediately, which we've now seen twice on rumors. I'm talking about the overhang, and the reason that I am not allowing my investment fund to allocate more to Bitcoin disappears at the same time as it's very clear there's going to be demand drivers too. So, you know, when you look at it, that's the biggest unknown. If someone knew for sure that Binance either A, did have a hole in their customer money and there will be forced selling, or B, that there isn't, you will be very rich by betting on that. Now, I obviously do not know that answer, but people need to understand that is a very good deal.
But I still think, though, Dave, that going back to the beginning of the show, I think there's this huge overhang of uncertainty in the economy, you know, and so we're starting to. So going back to your God candle comment, yeah, if there wasn't some sort of overhang from Binance and people believe that we're going to have this Goldilocks scenario of a soft landing, we would see a God candle. I think you're right if that got resolved, but I think people are starting to realize that the soft landing narrative might not really be true, and you're starting to see just hints of that. So when you have market malaise, that's when these disruptions happen. I think that Bitcoin, as much as anything, is going to be susceptible to that kind of downturn. And so we just have to be aware of that. Am I bullish long-term? Hugely bullish. I'm going to be buying all the way down if it does. And I'll take that opportunity with or without a Binance event. And so we just have to recognize that that's still out there. If we have a spike of unemployment, we have some sort of credit event, it will get hit too, period. Trying to time that, good luck.
Yeah, no, yeah. I always say that. Look, my macro views throughout history have been, my timing on macro has been, I really hate doing this when he's not here, but it's just too funny. My timing on macro views has been as accurate as McGlone's has been in terms of timing. That's not
everyone. I mean, you have to be Michael Burry and his 1 in 100 shot to be accurate.
No, I mean, in 2006, but even then, he almost went out of business because he was way early.
Right. So in 2006, I was shorting MBMA, Fannie Mae, Freddie Mac, and all that stuff. In 2006, I was totally right, but it went on 18. I was 18 months early and got stopped out of my positions for a variety of reasons. So I didn't lose money, but I didn't make money either. Despite calling, effectively the house of cards. What the hell?
I lost a lot of money.
So, I mean, I understand. I was directionally right. But look, I don't want anything I say isn't investing advice other than the only piece of investing advice I will ever give on this show. And I always say it. Don't use leverage on an 80 vol asset. Because if Bitcoin is an option, as I say, using leverage on options is a prescription for disaster. At best, it's a roulette wheel. At worst, it's a lottery. And, do you really want to invest by buying lottery tickets? I think not. It's not a smart idea. That's the only advice I give. Everything else is observational. And observational, the demand for Bitcoin in the 25 to 26 range is significant. There are resting bids. There are patient buyers, and the speculators at this point are exhausted. Every time it starts moving up, they get fooled, and so we don't have a lot of that. So we're kind of stuck in this range until there's new news to digest. And the news that people are mostly focusing on these days are the two pieces of news we talked about: is the Fed going to try to force a credit event? Remember, we talk about credit events in clinical terms. Well, what is a credit event? A credit event is an event where institutions are forced to sell assets. And when you start forced to sell assets, what do you sell? Well, you sell what's most liquid. What goes down the most? Why do correlations go to 1 in a market crash? Because it causes forced selling and people to sell the most liquid stuff, often the stuff they most want to own. And so that's why correlations go on.
That's right. We've talked about before. If you haven't been on a desk when this happens, a hedge fund desk and an investment committee, it's staggering how fast it happens. You walk into that trading floor, you see red across the board, you know that you're going to have some sort of margin call somewhere in your book, because look, if you're a hedge fund, you're at a prime broker, you're running on margin. It's just reality. There's no other way to pay the prime brokers. It's not that you're over levered. It's just that you're running on some sort of margin, facility. And so you look at your book and you say, just as Dave said, you say, just sell 20% of everything, get 20% of everything, get me out. And then we'll step back and make sure that we're at least liquid. So at the end of the day, I'm not having some sort of liquidation that's forced that I don't want to happen.
Right. And so that's a big deal. So, Scott, the other thing that's important to understand is a credit event virtually guarantees not just margins for people who are leveraged, but also redemptions. People pull their money out of funds. We have an entire generation that's been living off of the wealth effect. People start getting really nervous when their nest egg is when their nest egg is in the stock market, and that's what they've been living off of. Selling small amounts, to live, because there are a lot of people who've been doing that. And all of a sudden, if your net worth starts collapsing, what happens? Well, the whole thing pinwheels. And that's exactly, the Fed would actually probably wants a 20% correction. What they don't want is a death spiral. And so
they're already in one, right, James?
They're already in one. There's no way out, and it's begun.
There's a way out. There's a way out. There's a way out that traders are well aware of.
Can you see it now?
It's called a mass devaluation event.
In what world? I mean, truly, in what world is it okay that this is our federal debt, this is our consumer debt, this is our savings rate? You notice
We're
where
only
it
seeing
is.
the one screen. I think the way you shared it was probably just the that one tab, so you'd have to switch tab.
You have to show it each tab. Okay, hold on. So we'll do that. So that, right?
We lost you.
Versus
We lost your screen share.
Okay,
here we go. I'm going to teach everybody. You go to present.
Okay,
I'm going to take that off. You go to present, and then you go to share screen, and then up top there's Chrome tab, window, entire screen. Do window. This is for everybody, not just for us three guys when you're StreamYarding. So if you do window, you can click between tabs.
You see it?
There you go.
Yeah.
See, I can see your tabs up top. So there's consumer loans. Yep.
So you had federal debt, consumer loans. Here's the personal savings rate. You can see it's down, like it's down to the levels it was back in 2008. Okay. At the same time, you've got corporate bankruptcies rising at a faster rate than it has in years, right? So, in what reality is this okay? How is this going to work?
Well, keep in mind something. If he raises rates and the long end goes up, then those charts get worse.
Every single one of them. Every single one of that. The federal debt spikes. This is what, yes, Scott, we're in a debt spiral. Why? Because we're operating in deficit. Why? Because we spend too much. Clearly, that is inflationary in and of itself. So it just feeds on itself. So our average interest rate is about 1.5% on all this debt that we have. $33 trillion of debt. Every single time a piece of debt matures, now we have to reissue it at somewhere between 4.5% and 5%.
31%, I believe, is the number that's within the next 6 months or year of U.S. debt that's coming up to be refinanced and is going from 1% to what, 5, 6, 7?
Yeah, 1.5, 1.25, 1.5 to 5%. And every single one of those investors that doesn't reinvest that capital of that bond that has matured, the Treasury has to borrow that money and issue more debt, and that's what you're seeing happening. So you see debt matures. Part of that money, that when that's matured, it goes back into auction, and they buy more debt, or it goes into the open market. But part of it they have to just issue more debt, and at higher interest rates, your interest expense now this year is going to be over $1 trillion on interest expense. For people who it's hard to conceptualize what that is, we spend about $800 to $850 billion on the entire military complex a year, and
which is 5 times, which is more than the next 5 to 10. I don't remember the stat, but than any other countries combined.
So put it in context. It's like if you spend, say you spend $5,000 a year on food, and then you're spending about $7,500 a year or $7,000 a year on interest on your credit card debt, or put in the same terms, $800 a year on food, and now $1,000 a year on interest on credit card. Like, it's just mind-boggling. You're spending more money on interest than you are on something that,
But put it another way, which is what I've been talking about all year on this show. The Fed desperately needs to engineer the long end of the curve downwards, and the long end of the curve means people.
That means rate cuts.
That means something. It's yield.
Yeah, they're going to engineer it. They're going to engineer
it the way Japan engineered it, and that's what they're going to do. What it means is quantitative easing on the long end, and don't be surprised if they're quantitative ease on the long end at the same time as they hold rates above accommodative levels on the short end. Do not be surprised if they do that, because I think they need to do that.
Explain how they engineer that.
There's only so much money they can pull out of the reverse
repo
facility, right? And so all they're doing right now is they just keep issuing T-bills. and these are
But
expiring.
who's
They're
buying them?
a month to 3 months. It's money coming out of the reverse repo facility.
But who's buying them?
Rich people and piles of money. Read Arthur Hayes' stuff. That's what he's talking about. And that money, that interest.
But rich people haven't bought $1 trillion of new debt in the last 3 months, right?
It's banks using it. It's banks buying
Reverse repo.
They're taking money out of the reverse repo rather than just pushing money to the Fed and getting reverse repo interest rate. They're getting a better interest rate on T-bills. And so they're just re-upping those T-bills. And so you've seen about $600 or $700 billion being drawn out of the reverse repo facility, which is just extra capital that's sitting idle at banks. They put on the Fed to get interest every single day. And so instead of leaving it there, they're pulling it out and putting it into a little bit better rate on the T-bills. But they can only do so much of that. Right. There's only so many banks that are sitting on that capital. So like Dave said, at some point, the Fed, the Treasury, is going to have to issue longer dated paper. And when they do that, who's going to buy it? Who's going to buy the longer dated paper?
The Fed. It ain't going to be China.
I mean, look, think of it this way. How many people were complaining about Japan's lost decade, yada, yada, yada. You can complain about it a lot. But the fact of the matter is
just yada, yada, yada.
Their debt to
America's
GDP.
lost 2 decades coming, yada, yada,
Yada, yada.
No, I'm not saying that.
That's part, Dave.
Yeah, you should. Yeah. The yada, yada, yada is solid, though. Yeah.
Here's the here's the punchline. The punchline is you can make fun of them. You could say a lot of things, but the fact is Japan has been able to kick the can down the road on their debt spiral for 30 years, despite having a debt to GDP that's double ours nominally now, and a population that's aging even faster. And so, if you're a policymaker who cares about your job and what people think about you now, the most human thing to do is to kick the can down the road so it's the next guy's problem, not mine. And, right. People want to do the right thing, as some people do. I think Powell genuinely does. I have genuine respect for the man. I think that at some point he's going to realize, listen, I got to kick this can down the road because I am toast. They are leaving me alone. I don't want to do it. And he's going to, he's sort of in financial policy, sort of like, Zach Wilson was left alone against the Cowboys pass rush. I mean, it's like, what the hell am I going to do?
He's terrible, but that wasn't his fault.
Yeah, he was running for his life the whole time. I mean, Powell literally is standing alone against the entirety of the rest of the government, the fiscal side of the government, the regulatory side of the government, and even the job.
And Dave, did you hear Scott talking about, the White House cheering on the UAW? I mean,
yeah. It's insane. It's like I'm telling you, I think it's crazy. At some point, the natural thing for him to do is within the policy committee and say, listen, we're going to keep rates high enough so that we're going to try to quell consumer demand, but we're going to do QE, which we all know what that will do. That will that will help support the asset markets at the same time as decreasing federal debt expenditures, because we need to do it. I mean, I just don't see he has a choice. I mean, he'll never say it. They won't talk about it, but they'll just do it because they have no choice.
But to your point, if the Treasury is just creating trillions in T-bills, then fiscal policy can't, the monetary policy can't account for what's happening on the fiscal side, right? That's money printing one way or another, right? And he's trying to tighten and trying to,
but they're operating with separate, they're operating with separate mandates. Objectives, right? Yeah. So the Treasury they have no choice, but they have
to pay the bills.
Facilitate
try to fund the government
spending. Exactly. They facilitate government spending, period. And the Fed is only trying to reinforce the strength of the dollar. They're trying to reinforce the confidence in the U.S. currency so that the Treasury can pay pay the government's bills. They're operating separately, and the Fed, like you just said, and you guys I 100% agree that, Powell is running for his life here, but at the end of the day, period, end of sentence, he is going to do what is best for his legacy. And
of course, it's all he cares about. You can tell. I mean, how many times does he have people invoked Volcker when talking about Powell? True. He needs his Volcker moment. He's going to pull it off. Right?
The only thing where those places agree on is they would strongly prefer to have measuring sticks, things that make it obvious what they're doing, not exist, or at least not it, or at least be different, right? So
and they do obscure it. They do obscure it with the faulty CPI measures.
Yeah, they do a lot of that stuff.
Yeah, just recalculate how you calculate the numbers. Great.
Powell knows that unemployment doesn't spike until we hit a recession. He knows that. Yet he will again. He will refer to unemployment being very low right now, so there's no recession risk. He will say that again, even though he knows in his mind that what he's trying to do is spike unemployment, period. That's what needs to be done. He needs unemployment to spike in order to quell demand, because it's the only side of the equation that he can. But
the narrative is soft landing, no recession. So, I mean, you're saying they're just lying. They're lying because he has to cause the recession, so he doesn't want no recession, to get jobs, to get unemployment to rise, to be able to pivot, to crash the market, and then recover.
I mean, it's so ludicrous that Yellen would refer to every single problem, and on that tweet that you showed at the beginning of the show, every single issue that we're facing, and say, "Oh no, we've got this."
That's good. It's good. We're just going to pause. Fine.
Yeah.
I mean, look, it is what it is, but that's one of the reasons why they don't want objective metrics. So, Greenspan used to obsess about gold, and a lot of the other Fed governors were, well, why do you care? And the fact of the matter was, if you look at the history, when gold did its sustained rally from the 400s, to its the 2011. 2000, what was that about? Well, that was about, well, we know what we went through. We went through the monetary printing. We went through all the stuff and basically just said, okay, I don't care. Let the gold bugs know the truth. Let the gold bugs measure it, et cetera, whatever. The same thing is likely happening with Bitcoin, only Bitcoin is global, not just the US, and its adherents are even more eccentric in their minds, and it's a much smaller market. And so you get all of that, but I think it's pretty clear that people say, well, Elizabeth Warren's a Luddite. She's trying to suppress this stuff. Oh, no. I mean, she's smart. She understands that Bitcoin is a measuring stick. And she understands that if federal government fiscal irresponsibility is to continue, they need to make sure that they can engineer against all the measuring sticks.
And she understands that she needs the fiscal irresponsibility to continue to have her job, period.
Right. And so that is a very big deal. And people ignore the political process or what's going on at their peril. But the truth is that there is a reason why there's institutional bias in the United States against crypto. And by the way, there is
the reason
why there's institutional bias for crypto in emerging economies all around the world, because they see it as an opportunity to help, basically get out from under U.S. financial hegemony. I mean, don't kid yourself. Yes, it is true that token and because we've seen it, we had 3 people out there. We see it overseas.
Bananas.
All of the demand for our services is overseas. U.S. The U.S. money, it feels trapped. People are annoyed, yada yada yada. But make no mistake, the U.S. today is 50% of the world's investable assets. There is a huge fight going on, and I do not believe that de-dollarization is the way they're going to win, because the dollar is still the best of a bunch of bad fiat currencies. But I think there are a lot of people outside of the United States who understand that there is a great reset going on, and there is potential in the digital economy, and that could be massive, and they're lining up to do it. And understanding the U.S. isn't going to get cooperation from these governments, because these governments really see it as a ticket for them to actually do better. And that is very important.
Which I think is actually maybe a good way to sort of conclude on that point, is that we used to expect that the world would follow the United States lead. And I think that's what the United States was expecting, that they would set some framework for regulation, get the rest of the world in line. And in this case, the rest of the world just said, F you, and moved on without them. And now the United States is totally stuck. They failed to kill it. They failed to really suppress the price. And now it's moving on everywhere else. And the only people that will obviously get hurt are America and Americans.
I mean, I wish I didn't agree with you. I really, really wish I didn't. But I have to agree with you, because I know that what you're saying is true. It's sad.
It's going to be very interesting to see what happens this election and who comes out on what side. I think 99% of politicians are going to come out on the wrong side of this. But You know, the next election, I think, after this one is going to be entirely different because of the damage that they're going to cause in using the central banks and fiat currency, period.
I was just checking if Elizabeth Warren was up for re-election in 2024. I believe she is.
She is.
So
Yeah.
good news.
So.
Good news.
Yeah.
She ain't going to lose, but it's nice to have hope.
Yeah.
Hope is a terrible thing if it's misplaced, though. All right, guys, that's all I gotta run. Thank you so much. It was fun to having the three of us. It's always interesting when we mix up the groups, how the conversation leads. James, it didn't even get light for you over there. I guess there's just no window.
It's still
just living in the dark, man. All right, guys. Thank you so much, everybody. I will be back tomorrow. See you at 9 a.m. Eastern Standard Time. Peace. Bye, guys.
Bye.
That's dope.